Size traders, how's it going? It's Amos here with Gary, head trader at SizeTrade. Gary, thanks for being with us today.
Hey Amos, how's it going?
Good, good. Market's been a little bit slow lately. I just wanted to ask you today, how do you suggest traders cope with these types of market conditions? What can a trader do?
Yeah, it's actually a good question, Amos. I'm glad you pointed that out. Yeah, I mean, look, the markets, we as day traders, when we day trade, we have to take what the market gives you. There's an old saying on Wall Street that says, bulls make money, bears make money, pigs get slaughtered. I think a lot of the traders in the last 15, 20 years, because there's been relatively high volatility in the markets, have not understood the pig side. Yeah, bulls make money, bears make money. That's great. Actually, bears probably haven't made much money in the last 9 years or so. But pigs get slaughtered. What does that actually mean? That means that when you get complacent, when the market's not giving you an opportunity to make money on the upside, it's not giving you an opportunity to make money on the downside, staying in a tight range like we've seen over the last 2 or 3 weeks, you get slaughtered if you try to trade it. If there's been tons of false breakouts, tons of false breakdowns. When you chase those breakouts, when you chase those breakdowns like we would normally do in a bullish environment or a bearish environment, you get slaughtered. So just to give you an example, the market broke on the 2260, went to the low 2250s. It actually looked like the market was going to break down. Wrong. Next day, even that same day, we rallied back into the 2260s. Next day, we were in the 2270s. It looked like a perfect reversal day. You had a false breakdown back into the range, and the next day you were touching the top of the range, breaking out. And again, all those people who got short the day before got crushed. All the people who got long that day got crushed because we went back down to the low 2260s. I think we even went into the high 2250s. So the point is that a profitable trader, particularly day trader, but a profitable trader in general, is one that's able to curtail the amount of time he gets chopped. So I remember when I first started out day trading, they told us, hey, trade the open till lunch, then take off lunch between 12 and 2, and then come back at 2. And I didn't understand that because I said, hey, if trading is not luck, if day trading is not luck, then every trade I do should have a high probability of me making money since I'm a profitable trader. But what I didn't realize is, and I learned it over time, is that during that time, there's no opportunities to take advantage of. That my strategies would only work when there was opportunity to make money. So let's take Eagle for example. If we're looking to make 6 points and the market only moves 10 points, it becomes very difficult to catch that 60% of that move. On top of that, a lot of times you're not going to catch the top or the bottom. So you kind of catch the middle. So if you're moving 10 points, the middle point is 5, the numbers don't add up. So if you push yourself to make money in this type of environment, you're going to get chopped up. That's what the whole point of chopped up is. And you're going to give up back at least 1 month, potentially a few months of your profitable trading. Now, the question is, that's okay. If you are trade breakouts, and this is what you do, and you trade breakouts, and 9 months out of a year you crush it on breakouts and breakouts and breakdowns, and you make 1,000 S&P points throughout the year, and you give back 100, 10% drawdown, that's great. The problem is that's not what usually happens. What usually happens is a trader will give back 30, 40% of his profits in 1 month because he's trying to chase these breakouts and breakdowns. He's reading the news. He's becoming a fundamental trader. Oh, well, this happened. Donald Trump said something bad. The market crashed. It's going to crash. It's going to crash. And then, of course, it doesn't matter because it was news that people knew anyway. And it doesn't really affect longer term trading habits. So the key is when you're building a strategy from scratch, you have to decide, are you going to build a trending strategy that's going to take advantage of trending trends, or are you going to build a scalping strategy that's going to take advantage of a scalping environment, an environment that's range bound? Typically, people try to build trending strategies because the market trends 70, 80% of the time out of the year. So building a scalping strategy for 20% of the time, it's tough because you have to sit on your hands for 80% of the time. When you're building a trending strategy, which I feel like the majority of profitable strategy builders build, you get into an environment where you make money or you have action 80% of the time, and then at 20% of the time, you either sit on your hands like we are right now and not putting many trades on, or you give back, but the amount you give back is reasonable or justified compared to the time you make 80%. So I'm actually happy that we're at positive, I believe 7 points for the month, which is not anything to write home about, but I'm happy that in this type of environment we're not giving back money like so many other people that I've spoken to have, and it's unfortunate. And I wanted to just bring this out so that if you're trading on your own, certain strategies on your own, you have to be comfortable with understanding that we're range bound, and sometimes the best trade you do is the trade that you don't do. So it's okay to miss 2 or 3 weeks of trading because you're gonna eventually the market it comes back. So this is gonna happen every year, no matter what. Will it happen in the first 2 weeks of January? Probably not. Will it happen in mid-August? Most likely. If you take a sample of 3, 4, 5 years trading, will this happen? Will you have Augusts that are not slow? Yes. Will you have Januaries that are not fast? Yes. So it all evens out at the end. That's kind of what I'm trying to say. So as long as you don't get crushed or give back a lot of money in these types of environments, you're actually ahead of the game because you're going to make it back when the market this year. I'm not saying it will be, but this year will be might be a little bit more active at different other parts of the year to make up for it.
So,
So basically, yeah,
so
go ahead.
Gary, we know that risk management is really the fundamental foundation of being a profitable trader here, and I think that's what you're touching on here, just being able to manage the risk properly here. And so, what's your suggestion right now for traders? How do they know if they're building these trending strategies? How do you know when you can start trading those trades again?
Again, every strategy is a bit different depending on what you're looking for. If you're looking for 50 points, it's a bit different than if you're looking for 6 points. But right now, I think you clearly see that the market's closing at 2260 every single day for the last 2 weeks. I'd like to see a close above or below there. I'd like to see not a slight close, so like not 2259 or 2271. I'd like to see, maybe a low 50s close, hold that area, not see a bounce back into the 2260 level, hold that area, maybe even trade a tad lower. And I think then you feel comfortable putting out trades again because now you've broken out of the range, and you could kind of chase the market a little bit and try to make money on the downside or the upside. I'm not predicting which way this will resolve itself. I don't think anybody knows. If it happens to go higher, great, we'll make money. If it happens to go lower, great, you'll make money. Um, the key is to make sure that you figure out what the range is. And right now, I think the range is pretty simple. It just seems to be 2260 closes, and anybody who gets ahead of himself or herself, and when the market is in the low 2250s or the mid 2270s, and either tries to get short or long, I think you're taking a big risk. And you might be right. It might be the time that we break the range, but you're more, the historical evidence of the last 2 weeks is that you're probably going to get chopped up as it goes the other direction and probably overshoots the other direction. That's been the other signal here is that when you had the false breakdowns the next day or in a few days or even the same day, you have a false breakout. And then when you have the false breakout the next day, you have, you're either back in the range or a false breakdown. So right now, let's take Friday for an example. We reached 2270. We breached 2250. Anyways, we went into the 2270s, we went into the 2250s, be it slightly and for short term time, and then we closed back in the middle of 2260s. So if you bought the breakout because you thought that's it's inauguration day, they want to take it higher, you got hurt because it went back down out of the 2260s. If you shorted the 2250s because you thought, oh, that's it, we're breaking down, he said something negative, market's not happy, you also lost money because it went back to 2260s. And that's part of the chop is that long, short, you get hurt either way. It's not that you're wrong. It's certain times you get short the market because you have either a technical pattern or fundamental pattern that tells you, oh, market's gonna go down, and you're just flat wrong. Market goes up, you get out, you take a loss. It's part of your strategy. You get long because now you think the market's gonna go up and you make it back and more, or vice versa. Sometimes you think the market's gonna go up, it goes down. It just happens that you're wrong. The problem with the chop, the problem with the sideways action, the problem with being a pig is that you can't make money long, you can't make money short. It's not about being wrong necessarily about the direction of the market. It's being wrong that the market will actually have a direction.
Go,
So, yeah, sorry.
no, go ahead. Go ahead, Gary.
So I was just basically saying that old mantra, rings true to this day, which is amazing. That, if you make money when the market goes up, that's great. If you make money when the market goes down, there's tons of opportunity to make money when the market goes up and down. And we try to take advantage of every single little bit of that. But when the market is sideways, you just have to be cautious or you'll get slaughtered.
Gary, thanks so much for your time. We'll stay tuned, and as always, SizeTrader, subscribe. We'll keep you updated. Till next time, Gary, this is Amos, and we'll be in touch. Thanks, Gary.
Thanks a lot.